Nowadays online you're seeing tons of people make millions of dollars, investing millions of dollars, and it seems impossible to ever be at that level, but all of the people who do that had to start with their first $100. Hello everyone, my name is Jack Murphy, and in this video I'm going to show you how to invest your first $100 with ETFs or stocks. But before we get started, I highly suggest you start making an emergency fund with 6 to 8 months of expenses in it before you do this, because if you have an investment portfolio but no emergency fund, and then you have an emergency that costs a lot of money, then you'll have to probably start selling from your investments, which could cause you to lose money if your investments are down at that time. I would also suggest that you pay off all your high interest debt before you start investing, because if you have 15% interest on your debt, you're most likely not going to make over 15% in the stock market consistently. So paying off that debt will give you better returns than investing in the stock market. So it is just better to get that out of the way before you start investing. But once you got those two things handled, then you could start investing. This first $100 you use to invest should be for learning purposes. Now you could always go on one of those websites that lets you do paper trading, like trading with fake money. I don't think you get the same experience with those accounts, even though they mirror the stock market with fake money, because when you use your real money, there's emotion involved and that affects how you trade. So I think trading with small amounts of your own money is better than using those paper trading accounts, because it gives you a more real expectation of what's going to happen when you invest with more money. Now the first thing I recommend you do with your $100 is invest in some books. You don't want to blow your whole budget on books, but there's two I'm going to recommend that I think is a good start. So the first book I recommend you get is Rich Dad Poor Dad. This is kind of like the staple of finance books and how to learn about personal finance. This book kind of goes over how to make your money work for you and how passive income can kind of take over your job, and you could retire when you build up enough assets to generate the passive income that pays for your expenses. And it kind of just is like a general how to build your wealth and how to become financially set. So it's kind of just a good book to learn how to do that. It's not kind of specifying on stocks, which I'm talking about in this video, but I think it is a good book everyone who wants to retire wealthy should read. The second book I would recommend is Warren Buffett's Interpretation of Financial Statements. This is a very good book for learning how to understand financial statements, and I'll talk about this more later in the video, but when you're researching stocks, understanding the financial statements and the balance sheet is very important to determine whether a company is good to invest in. So understanding how to read financial statements is important for investing, and this book helps you do that. So I would recommend getting this book also with your first $100. There are tons of other great books on investing and finance, and you should definitely try to get some of those too, but you don't want to blow your entire budget on more books. So for now, those two are good to start. Read them, and then you can spend the rest of your budget on actually investing. So the second way you can start investing with your first $100 is through ETFs. These are a type of investment that you can buy like a stock on the stock exchange, but it is designed to track something like the NASDAQ or the S&P 500, or just like a basket of assets all in one spot. This means when you buy an ETF, you're essentially buying hundreds or thousands of different stocks or assets in one spot. So the main benefit of investing with ETFs is it gives you a lot of diversification. By owning a basket of different stocks, you spread out the risk. So if one of the assets in your ETF performs badly, the risk is mitigated amongst all the other ones, which are probably not doing as poorly. This is a great option for someone who wants to invest passively. By passive, I mean someone who's not actively buying and selling different stocks and just wants to buy something and hold it without thinking about it for the rest of their lives. I recently made a video about how to build a strong ETF portfolio, and I go into depth on that in the video, link in the description. But in summary, you basically can just buy a broad market ETF, a growth ETF, and a dividend ETF, and you have a pretty solid portfolio right there, and that's really all you need to invest passively. But ETF investing doesn't have to be passive. You could also look for more specific ETFs that follow a specific industry, and you can invest in those and have diversification within a specific industry. For example, if you want to invest in AI, there are ETFs that probably track all the companies that are investing and creating AI, and then that could be potentially a lot of growth in the next 20 years, more than like just buying the S&P 500, but that also has a lot more risk. So you got to decide if you want to do that or not. You might be thinking, how do I buy any ETFs with the $78 remaining in my budget? Well, nowadays a lot of brokerages have fractional shares, so you can buy a couple dollars worth of an ETF instead of the entire share, which could be worth over $100. Not all brokerages let you buy fractional shares of ETFs, but one that does is Robinhood. Robinhood lets you just buy assets in dollar amounts instead of shares, so you can buy just $5 of SCHD, for example, instead of the almost $80 it costs right now. If you want to make a Robinhood account, there's a link in the description, and if you open it with that link, you can get a stock between $5 and $200 when opening that account. So if you want to add to your budget of $100, that could be a good way to do it. The third way to invest your first $100 is with individual stocks. ETFs are great, but if you enjoy doing the research and picking individual stocks, then just investing in ETFs is not enough for you. When you invest in individual stocks, you're taking a lot more risk, but you're giving yourself room for a lot more growth and a lot more reward. When investing in individual stocks, you want to diversify those stocks, because if you have all your money in one company and that company goes down, you can lose all your money at once. So when you're investing in individual stocks, try to diversify by buying stocks in different sectors. So if that sector is not doing great in the economy, then you're not losing all your money because you're diversified. Like the ETFs, you can buy individual stocks in fractional shares because a lot of stocks are worth more than $100. So you could just have like $5 of 20 different stocks if you just use all $100. And this could be a good way to diversify and not spend all your money on one stock. So you can use brokerages like Robinhood or Charles Schwab. I use both of them, and Charles Schwab also lets you do fractional shares for S&P 500 companies. When picking individual stocks, you want to do a lot of research before you buy that stock. So for example, you want to be able to research their financial statements, and that's where the Warren Buffett book comes in. It'll teach you how to read the financial statements, the balance sheets, the income statements, and this can help you determine if the company's financials are good, and that means it could be a better company to buy. You also want to look for companies that are future-proof, meaning they'll probably be needed for the next 20 to 50 years, and you'll have no problem holding on to them because they will continue to grow. If you watch a lot of the other videos on my channel, you might know that I like investing in dividend stocks. Now, dividend stocks aren't always, but they do tend to be more established companies, and because they are more established companies, they are able to pay their shareholders dividends, which are basically just payments for holding the stock. If you've read Rich Dad Poor Dad, you know that these dividend payments are basically a form of passive income, and passive income can be used to pay off your expenses. So if you have enough passive income, you can pay off all your expenses and not need to work a job. And not only are these dividend stocks going to pay you dividends, but they're also going to appreciate in value as well. So your money is well spent with good dividend stocks. Like I said before, $100 is not going to make a big difference long term. So you're going to have to try to contribute weekly. It doesn't have to be weekly, but I think it is good to get in a habit of putting at least $5 or $10 into investments every week, so you can start building up your portfolio and compound interest can start growing your investments. If you want to be serious about investing, you have to understand that $100 is not going to turn into $1 million by itself. Unless you get lucky and gamble on the next crypto coin, it's probably not going to happen. People become wealthy through investing consistently and time. Time is the factor that takes people away from investing smart because they want to get rich quick, and it's just not realistic. $5 and $10 doesn't seem like a lot of money to invest every week, but the longer you do it, you'll eventually be able to contribute a little more, then a little more, and then a little more, and soon you'll be doing $100 a week, $100 a day maybe. It's all about consistency and building habits to invest like that. And the last method of investing your first $100 is into retirement accounts. A lot of young people don't invest for retirement because it just seems so far away and it doesn't seem like something you need to worry about now. But if you want to retire early, you got to start investing early. That is the best way unless you get lucky and win the lottery. Investing in your retirement accounts is the same as investing in the ETFs or individual stocks. You're just doing it on an investment account. Let's say, for example, you work for a company that has 401ks and they will match your 401k. This means if you put in $100 and they match it 1-to-1, they will also give you another $100 in that 401k. So that is an instant 100% return. That's not that common. You're more likely to see a 50% match. So if you put in $100, they will match it with $50. Even that is a 50% return instantly, which is very good. Now when you're investing in that 401k, you have now $150 or $200 to start investing in ETFs or individual stocks. So that is an advantage of going with the retirement accounts first. Another retirement account that has advantages is the Roth IRA. The Roth IRA is a tax advantage account, and their tax advantage is they let you pay your taxes before you start investing. So when you retire and want to take your money out, you don't have to pay taxes on your gains. I'm just going to make up some numbers. So say your investments grow $100,000 in your Roth IRA. So when you turn 59 and a half and are able to take that money out, you will get $100,000 with no taxes. Or let's say you're going the dividend route and you put your dividend stocks and dividend ETFs into your Roth IRA. You can take those dividends out tax-free when you turn 59 and a half. So that is a great reason to invest in your Roth IRA over a taxable account. It is important to know that these retirement accounts themselves are not investments. These retirement accounts are just placed to hold your investments where you get some type of benefits for retirement. So in the 401k or the Roth IRA, when you put your money into them, it's not going to grow over time. You have to actually buy ETFs or buy stocks in these retirement accounts to see growth. So sometimes people just put money into a Roth IRA and then leave it because they think that is the investment itself, and that is a big mistake you need to avoid, so don't do that. I have a Roth IRA on M1 Finance, and I think that is a good place for a beginner to start investing because M1 Finance is pretty simple to invest on, and it is a good brokerage. I'm not going to go in depth on how to use these retirement accounts in this video, but if you go online and do your research, these retirement accounts could be very, very good opportunities for you. But if you do it wrong, if you don't invest into these accounts right, you could be missing out on a lot of opportunities. So if you're going to go the retirement account route, make sure you do a lot of research on that on your own. Your first $100 can be a great start for investing and is a great learning opportunity. Don't stress about losing this $100 and don't stress about the learning curve because it just takes time and practice to understand how to invest well. You're already ahead of the game because you want to start investing and you're going to start with your first $100. A lot of people aren't taught how to invest, and that's just a big problem with the education system, but you're doing it now, you're learning, and that is a good step forward. If you want to watch my video on how to make the ultimate ETF portfolio, check it out here. And if you want to watch my video on a simple investing strategy that every investor should know, check out this video. And if that's all, peace.